Are you just getting started in hard money loans, learning about hard money loans and how to use them to make money in real estate? There are some really important terms that are used in hard money that you really need to know. And when I say terms, I mean the words that are used or the vocabulary that's most commonly used in hard money loans. Watch this video to learn about the most commonly used verbiage in hard money loans. And stick around until the end of this video to find out about one term in particular that if you don't know what it means, it could cost you a lot of money. First off, what is hard money? I mean, what does that mean, hard money? A hard money loan is any loan against a hard asset. And what's a hard asset? A hard asset is any asset that can be liquidated fairly quickly for cash, such as real estate. Now, there are some terms that are used pretty interchangeably to describe hard money loans. Those terms are private money loans, bridge loans, rehab loans, gap loans, and mezzanine loans. Although these words are all slightly different, they're used commonly to mean the same thing, hard money loans. Now, what are some of the most commonly used words that in hard money? I'm going to go through some of those with you right now. The first one that you're going to hear a lot is proof of funds letter. What is a proof of funds letter? That is an approval letter that you get from a hard money lender that you can use to make offers on properties, and it says you're approved for a hard money loan. Another term that is most commonly used in hard money is upfront fee. Those are any fees that you're going to pay in advance of getting a loan. And you will see that in loan scams. People ask for money up front, an upfront fee in advance of getting a loan. Often that can be a scam. Another word that is most commonly used is loan to value. It's abbreviated by LTV. What's loan to value? It is the loan amount as compared to the value of the property. Let's say the value of the property is 100 grand. You're getting a loan for 80,000. That's 80% of the value, or 80% loan to value, or 80% loan to LTV. Check out this video that we did on this topic called What is LTV? You can find that on our YouTube channel. ARV, or after repair value, another term you'll see a lot. And that is most commonly used by flippers, people that are buying properties to rehab and flip. After repair value, or ARV, refers to the future value of a property after it's been fixed up. Loan term, okay, not to be confused with loan terms with an S. A loan term is the length of time that you are going to need a hard money loan for. So if you need a loan for 6 months, the loan term you're seeking is a 6-month loan term. Points. A lot of you have heard that term before, but you don't know what it means. Points are loan fees, and 1 point is equivalent to 1% of your loan amount. Then you've got front-end points and you've got back-end points. It's exactly what it sounds like. A front-end point is paid when the loan closes on the front end. A back-end point is paid when the property sells and the loan pays off. Junk fees. You're going to hear that word a lot, and you need to know what it is. A junk fee is anything that's not an interest rate or a point. It's another fee that a hard money lender is going to charge you in addition to the points and the interest that you're going to pay. And what are some examples of junk fees? Could be doc prep fee, could be underwriting fee, could be repair escrow draw fee. So those are examples of some junk fees. Maturity date. Really need to know this one too. What is a maturity date? A maturity date means when your loan, your hard money loan, is coming due. So if you have a 6-month loan, your maturity date is going to be in 6 months from today. So it's the date that the loan is due. Now, hazard insurance. Lenders are often going to ask you for this, and they'll always ask you for this, regardless of what type of loan. But in hard money, you're going to hear lenders ask you for hazard insurance, and that is going to be a basic insurance policy that's going to cover your property and protect the lender from loss if the house burns down or some other damage occurs to the property. Title insurance. You're going to need to get title insurance with any hard money loan that you get. And that is just going to be an insurance for the lender that the title is good on a property. Exit strategy. What is an exit strategy? An exit strategy is your plan for paying the hard money loan back. Are you going to sell the property? Are you going to refinance the hard money loan with another loan? What's your exit strategy or your plan for paying the hard money loan back? And then prepayment penalty, you're going to see that abbreviated as PPP, prepayment penalty. What is that? That is a penalty that you are charged in the form of a fee for paying off a loan early. So if a loan is a 12-month loan and it has a 90-day prepayment penalty on it or a 90-day PPP, that means that if you pay that loan off before 90 days, that you're going to pay additional fees or interest for paying that loan off early. And then finally, the last term that you've been waiting for to the end of this video is one of the most important terms that you need to know in hard money. And that term is default interest rate. Okay, so you've got your interest rate that's laid out in your promissory note when you get a loan. And then if you dig in that document a little bit further, that promissory note, you're gonna find what's called a default interest rate. And what does that mean? That means that if the loan goes into default, and a loan can go into default for a couple of reasons. If you don't make payments on the loan, or if there's some clause or provision that you're not complying with, or let's say the loan has come due and you can't pay it off, your loan may go into default, which means that it's not in a good status. And a default interest means that when your loan goes into default, you pay a higher interest rate. So let's do an example. Let's say the interest rate in your note, your promissory note, and your hard money loan is 12%. And the default interest rate is actually 25%, quite a bit more, right? That means that if you default on any terms that are part of that loan or part of that promissory note, that your loan goes into default and all of a sudden now you're paying 25% interest rather than 12% interest, okay? So that's a term you need to know and understand. Anytime you get a hard money loan, make sure you know what your default interest rate is before you get that loan, and make sure you understand what things would cause you to go into default on your loan and have to pay that higher interest rate. Well, hopefully some of this vocabulary has helped you navigate the waters of hard money loans so that you can better evaluate the loans and understand the terminology that's used in these loans to make better decisions. This is Corey. I'm a private money lender. If you have any questions, leave them in the comment section below. To see more content like this, hey, subscribe to our channel and like this video.